In the last video, I showed you why this crash is being misunderstood by almost everyone watching it. In this one, we go one level deeper, past the headlines, past the TV talking points, past what institutions are saying, and we focus on what institutional money is doing with real capital in real portfolios right now in late March 2026. Because there's a private research note circulating right now among the most powerful allocators on Earth, not among everyday investors, not among casual market commentators, among the kind of clients who pay tens of thousands per year for access to what top-tier bank research desks actually believe behind closed doors, separate from what gets said in public interviews. And what that note implies about the next 30 to 60 days of American economic life is something you deserve to understand. Because the difference between the investors who will look back on March 2026 as the greatest wealth-building window of their lifetime and the investors who will remember it as that crisis they survived is not intelligence, connections, or a fancy terminal. It's whether you understand the mechanism that turns geopolitical catastrophe into financial opportunity, and whether you position before the policy panic, not after it. Here's the setup. It is Tuesday, March 31st, 2026, 5 weeks and 2 days since Operation Epic Fury began on February 28th, the night American and Israeli aircraft struck Iranian military installations. Iran responded by doing the one thing the global economy feared most, seizing effective control of the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's traded oil flows every day. Brent crude is trading around $113 a barrel this morning, up from roughly $73 just 6 weeks ago. That's a 55% surge in a single month, confirmed as the largest monthly gain in the history of the Brent contract dating back to 1988. WTI, the U.S. benchmark, is hovering near the same zone, roughly around $112. The previous monthly record for oil was a 46% gain in September 1990 during the First Gulf War. That record just got shattered. Now look at the rest of the board. Gold opened 2026 near its January all-time high around $5,500 an ounce. It's now trading near $4,530, down roughly 19% from that peak. Silver has fallen even harder. The S&P 500 is down about 7.5% from its January high. The University of Michigan Consumer Sentiment Index has collapsed to 53.3, its lowest reading since late 2025, putting confidence near the bottom percentile of the survey's recorded history. Year-ahead inflation expectations jumped to 3.8%, the biggest one-month rise since April of last year. Gas prices in California are flirting with $9 a gallon. This is what I mean by an everything crash. And I want that phrase to land correctly. An everything crash isn't just stocks falling or oil spiking. It's when the usual places people hide, stocks, gold, confidence, stability, start moving in ways that feel contradictory. It's when stress spreads through multiple asset classes at the same time and the normal playbook stops working. And right now, the people managing the largest pools of capital on Earth are doing one of two things: panicking and selling, or freezing and doing nothing. Both of those reactions, I'm going to argue, will look catastrophically wrong 6 months from now. The investors who will be right are the ones who understand not only what is happening, but what always comes next. Because what always comes next, after every major oil shock of the last 50 years, is the same sequence. A policy panic followed by a violent, fast repricing upward of the most beaten down assets. Not sometimes, not maybe. The pattern is consistent because the incentives are consistent. So let's start at the beginning, specifically with the mechanism that this private Bank of America note highlights. Because once you see the mechanism, the opportunity in late March 2026 becomes not just visible, but almost obvious. Here is the key sentence. Bond yields are falling even as oil trades above $113. Read that again. Bond yields are falling while oil sits at its highest levels in years. That is not what the textbook says should happen under the inflation-fighting regime that dominated central bank thinking through the early to mid-2020s. In that framework, oil spikes and higher inflation expectations should push yields higher, push the Fed hawkish, and crush rate-sensitive assets. And for a brief window after the war began, that's exactly what happened. Yields rose, the Fed sounded cautious, and the inflation-fighting script played out. Then something shifted. The bond market, the biggest, deepest, most sophisticated market on Earth, began sending a different message. And the bond market is not dominated by retail emotion. It is dominated by institutions whose entire job is to understand macro cause and effect. Bank of America's internal framing puts the shift like this. When oil is in the $80 to $100 range, inflation risk dominates. The Fed can plausibly talk tough. The market can plausibly price hikes or at least higher for longer. But above $100, the arithmetic flips. Oil at these levels becomes so economically destructive, so damaging to consumer spending, corporate margins, airlines, manufacturers, and discretionary income, that recession risk begins to outweigh inflation risk. And once recession risk dominates, the Fed does not keep tightening. It pivots, it cuts, or it eases through the back door, liquidity operations, balance sheet actions, and the familiar QE, but we'll call it something else, playbook that has been used in every crisis since 2008. That pivot from inflation fighting to recession fighting is the hinge. And Bank of America's note describes what follows as a policy panic. Not a polite adjustment, a panic. The only questions are what triggers it and when. Now, two things can be true at the same time, and this is where people get lost. Goldman Sachs has acknowledged that another 5 to 7% downside remains possible if the strait stays constrained. And Morgan Stanley's Michael Wilson has pointed to technicals like RSI readings flashing oversold levels not seen since 2022, suggesting the correction may be entering a late stage. Both can be true. There can be more downside, and this can still be close to the end. Because the goal is not to nail the exact bottom. The goal is to understand which assets will move fastest, most violently, when the policy panic arrives, and to be positioned before the move happens. Here is the brutal truth that banks discuss privately and almost never say out loud in public. Confirmation comes after the move, not before it. By the time the headlines say, the market has turned, the people positioned correctly are already up 20 to 25% in the names that rebound hardest. So what is institutional money preparing to buy? This is where the information gap between institutional and retail investors is biggest, and it starts with a distinction that matters more than almost anything else in a crisis. The difference between assets that are structurally impaired by the oil shock and assets that are only temporarily repriced by the oil shock's impact on sentiment. That sounds academic. It isn't. It's the difference between buying something that can recover and buying something that deserves to be lower. Structurally impaired at oil near $113 airlines. They face immediate fuel cost pressure that compresses margins in the current quarter, not someday. In a recessionary environment, their pricing power is limited. Buying airlines here is buying into a business whose core cost structure just got hit. Also structurally impaired. Unprofitable growth companies dependent on cheap capital and strong consumer demand at the same time. Also impaired. Companies with meaningful exposure to Middle East supply chains or distribution routes tied to Hormuz. These businesses aren't temporarily misunderstood. They are genuinely worth less under this regime. Now, temporarily repriced by sentiment, this is where the note identifies the opportunity. First category, energy infrastructure. Not oil producers themselves. Those spiked hard right after February 28th and have become crowded. The opportunity is not in the obvious, oil is up so buy drillers trade. It's in the infrastructure layer. Pipelines, storage terminals, LNG facilities, the toll road businesses that move hydrocarbons rather than produce them. Think Kinder Morgan, Williams companies, broad exposure like the Alerian MLP ETF. These businesses earn fees on volume moved, not on whether Brent is $80 or $113. They can benefit from elevated energy activity without the same commodity price risk, and they stand to benefit from something even bigger, the long-term restructuring of global energy routes. Every country just watched a single choke point disrupt the world. Redundant infrastructure spending doesn't stop when the strait reopens, it accelerates. Second category, defense and aerospace. But not as a short-term war trade that you flip when the shooting stops. Institutions treat defense in 2026 as a multi-year spending regime. After 9/11, defense stocks outperformed the S&P 500 by roughly 47% over the following 5 years. That wasn't because the wars lasted exactly 5 years. It was because the spending realignment persisted long after the initial shock. Broad exposure, like the aerospace and defense ETF, can capture the theme without single company bid risk or reputational surprises. Third category, the psychologically hardest trade, and that's precisely why it matters. Consumer discretionary. Restaurants, retail, travel-related discretionary names, and even certain luxury categories are being priced as if the American consumer is permanently broken. More than half the stocks in the consumer discretionary index are down 20% or more from prior highs. and the historical data on what follows this level of pessimism is striking. In 23 of the previous 28 times discretionary hit this kind of relative depression, the sector produced an average of about 14% outperformance over the following 12 months, an 82% historical hit rate. The moment this trade works is the moment it feels most impossible. When gas is near $9, sentiment is collapsing and it feels ridiculous to buy anything connected to consumer spending. But that feeling, the visceral, this is the worst time, is exactly what maximum pessimism feels like. And maximum pessimism is what tends to precede recoveries, not extend declines forever. The American consumer is not permanently broken. The American consumer is shocked. Those aren't the same thing. Fourth category, software and consumer finance. Software is being treated as though the AI revolution has been canceled by a shipping choke point. It hasn't. The data center capex cycle is driven by competitive dynamics among the largest tech companies, not the marginal cost of oil. Microsoft, Amazon, Google, Meta, hundreds of billions in AI-related investment doesn't evaporate because Brent is high for a few months. And yet software is being sold alongside everything else in a deleveraging wave. Consumer finance benefits when rates fall. And as you already saw, the bond market has started pricing that direction. Yields falling in the face of oil tells you the recession framework is taking over. Now let's talk about gold because its current price is being misread. Gold started 2026 at an all-time high near $5,500. It's now near $4,530. The casual take is gold failed. The accurate take is more nuanced. Gold has been hit by forced selling, margin calls, institutional liquidation, algorithmic flows, pressure that is often disconnected from the long-duration fundamental argument for gold. The structural case for gold, global debt, U.S. debt load, the long-run reality that high rates are mathematically difficult to maintain, did not deteriorate because of the Iran war. If anything, the fundamental argument is stronger. But in crisis moments, even strong assets can be sold to meet liquidity needs. That's what forced liquidation looks like. Now I want to give you 3 rules, observed through decades of crisis investing, that translate this into something you can actually use right now. Rule 1. Don't buy what already spiked. This is the most obvious rule and the most violated. Oil producers and certain defense names spiked immediately after February 28th. The people who were positioned beforehand or who moved early captured that. Buying the most obvious winners 5 weeks later is often how retail arrives at the party after institutions have already taken their first profits and rotated. This is not a statement that energy and defense are bad. It's a statement about how crisis gains are distributed. The first move belongs to positioning. The second move belongs to sequencing. Rule 2. Follow the money, not the headlines. The headline is oil at $113. That's what cable news talks about. The signal is yields falling despite oil being above $100. That combination is the bond market telling you recession risk has overtaken inflation risk, and that changes which assets rebound hardest when policy pivots. Rate-sensitive stocks. Beaten down consumer names. Technology not structurally impaired by oil. Gold once forced selling passes. Rule 3. Remove leverage before you do anything else. This is the unsexy one, but it's the one that decides who survives. If Goldman is right and another 5 to 7% downside is possible, leverage will force you out at exactly the wrong moment, right before the rebound that happens when policy panic hits. The people who made generational wealth in 2009 and 2020 weren't necessarily the smartest. They were the ones who could hold. The people who got wiped out weren't always wrong on direction. They were leveraged. Remove leverage first. Position in beaten-down assets with intact structural cases second. Let policy panic do what it always does third. That is the institutional sequence. Now zoom out to the historical context because it matters. The International Energy Agency has characterized the current Hormuz disruption within this scenario as the largest supply shock in recorded oil market history. And every oil shock of comparable scale has produced major opportunities for investors who understood the mechanism instead of chasing the headline. 1973, the Yom Kippur-era shock preceded a massive multi-year repricing in hard assets, including gold. 1979, the Iranian Revolution-era shock reshaped energy and defense spending regimes. 1991, the Gulf War shock resolved into broader recovery that rewarded those positioned early. 2001, after 9/11, a structural shift in security spending persisted for years, and gold entered a long bull phase. 2008, Quality assets bought in the depths delivered extraordinary decade-long returns. This 2026 Iran war shock, framed by many observers as the most structurally significant energy disruption since the 1970s, will end. The strait will reopen through some combination of military outcomes, diplomacy, and economic pressure. Even the political signaling around potential off-ramps is something markets are watching closely. Oil at $113 does not persist forever because demand destruction eventually overwhelms supply shock. You can already see it in collapsing sentiment and the recession shadow the bond market is pricing. That's how these episodes resolve. Oil comes down, the Fed pivots, policy panic arrives, and the assets that were crushed in the shock phase rebound faster than people believe possible. Right now, the S&P is only about 7.5% below its January high. Gold is about 19% below its January peak. Consumer discretionary is full of names down 20% or more. These are not the readings of a market that has accepted the new normal. These are the readings of an acute shock phase. And acute shock phases historically precede recovery, not endless deterioration. The rally will come. The policy pivot will come. The panic easing will come. And it will reward the investors who positioned before certainty arrived. So here's what you watch next. Watch yields. If they keep falling while oil stays elevated, the bond market is reinforcing the recession-dominant framework, and the policy panic is getting closer. Watch for credible diplomatic signals, anything suggesting de-escalation or back-channel movement. Markets move on credible direction, not perfect clarity. Watch for shifts in Fed language from inflation caution to recession caution. Those are the triggers, but the positions must be built before the trigger, not after it. The trigger creates the move rewards the position has to already exist. Now I want to know where you stand. Are you positioned for the policy panic? Or are you sitting on the sidelines waiting for certainty that won't show up until after prices have already moved? Because this moment doesn't have one guaranteed outcome. It has a framework. And the investors who hold the framework, who understand the sequence, not just the headline, are the ones who will look back on late March 2026, not as the crisis they endured, but as the opportunity they took.